So basically, let me recap what we did last time. So we move on to the main topic, market risk, of which we started with basic introduction to market risk and different components we discussed. And the definitions of the interest rate structure. What do you mean by interest rate? And term structure of interest rate and so on. And also the composition of yield curve, the interest to be different components. And mainly the different structures of yield curve, such as positively sloped, negatively sloped, shaped, flat yield curve, and so on. Okay. Then we came to the first major risk related to market risk, interest rate risk. That is coming from two components, earnings and value. So the earnings part, interest income, net interest income spread, and ROA and ROE. Value part, the value of investment portfolio, loan portfolio, deposits, and ultimately capital. Then we explained about how the interest rate would affect your, all the different components of interest rate risk, such as refinancing risk, reinvestment risk, and the market value risk. The refinancing risk and reinvestment risk arise from the banking book. Market value risk arise from the trading book. And a couple of examples. So I think where we stop there. Are there any questions before we move on to the today's part? Anything? No? Okay. So let's briefly look at the different sources of interest rate risk. Look at, there are four main sources of interest rate risk. So those are repricing risk, yield curve risk, then basis risk, and the optionality risk, right? So those are the key parts of interest rate risk. Then let's move on to the repricing risk. Now, what do you mean by repricing risk? Anyone? Any thoughts? Now, this is the risk basically arise when your assets and liabilities are not, matched in terms of maturities. Because repricing means now whenever the interest rate changes in the market, you have to reprice your. Reprice means here the repricing means the interest rate adjustment which you are doing at different points. Now, let's say if you have more short-term liabilities than assets, so your liabilities has to be repriced at shorter intervals. So your price get adjusted at shorter intervals compared to your assets. So now, if you take a scenario of interest rate rising, then what happens? So you have to reprice your liabilities more often at a faster rate, and then the repricing of your assets. Now, in a rising interest rate environment, so this will have a negative effect. So the primary and most often discussed form of the interest rate is arising from the timing differences in the maturity and repricing, okay, of bank assets, liabilities, and off-balance sheet position. While such repricing mismatches are fundamental, now this is fundamental, of course, you can't avoid that. If you do the banking business, this is there. Okay, but which can affect which can affect the income and underlying economic value. So this is why if you look at in the last couple of years, last almost 1 year or so, the banks had the advantage of free pricing, right? What is the reason? Last 1.5 years. What is the reason? So banks are happy, but when opposite happen, banks will not happy. Can someone, I think we have quite a large number of participants who have at least around 10 years experience. So what is the reason? Banks were very happy. And for they benefited, really.
Since the interest rates are coming down, sir, interest rates for the liability assets are coming down. Sorry, there's liabilities are coming down, whereas mostly the pricing for the advances remains as it is because it is connected to a space. That means a term. So because of that, banks are getting the advantage over that. Because in terms of margins. So that is why.
Okay, thank you. Any other thoughts, any other views, anybody else, if you have to comment anything? I think that is right. Now, if you look at past 1.5 years, the interest rates were coming down. And when you have shorter maturity liabilities, mainly the deposit, you reprice new deposit at a lower rate, right? So you replace higher interest rate deposit with lower interest rate deposit now. But for your assets, which are much longer term, you didn't want to do it immediately. Of course, the new lending you would have repriced, priced at a higher rate, but lower rate. But existing loans were not required to reprice because generally those are at fixed rate. Unless those are floating off, if it is floating, of course, there is adjustment. But since most are fixed rate loans, then definitely, there is, due to this mismatch, definitely repricing did not affect your income side. Of course, expenditure side, it has a positive impact. So that's why this inherent maturity mismatch will have a, interest, we call interest rate risk. This is arising from the repricing, right? So you see, but now that is generally happening, but the banks are a little bit reluctant when opposite happens also. So if the interest rate rise, what happens then? Generally banks will not adjust because anyway the fixed rate loan they can't do anything, but the banks reluctant to mobilize deposits at a high interest rate. So the effect is different. Should happen, but banks will be reluctant. The adjustments are very slow, right? Okay, so yield curve risk. The repricing mismatches can also expose a bank to changes in the slope and the shape of the yield curve. Now, yield curve risk arises when unanticipated shift of the yield curve have adverse effect on banks' income or underlying economic value. Okay. Now, for instance, underlying economic value of a long position on a 10-year government bonds held by a short position of a 5-year government notes could decline sharply if the yield curve steepens. Okay. So yield curve risk means now, especially when you use different assets and liability for structure the balance sheet, any rise or drop, or maybe I'll put this way, any shifting of yield curve either upwards, downward, may not happen parallelly. Steepness will be different. You see, you got what I thought. Now, steepness means, now when yield curve, let me see whether I can explain you. Can you all see the board? Can you all see the board?
Yes, sir.
Okay. This is the yield curve. This is the time. Okay. This is the interest rate. Now let's say present yield curve is like this, right? Can you all see? If you can't see, please tell me. Anyone who can't see? I think some of you can see me, and I think definitely others would be able to. So this is the yield curve. Now let's say interest rate rises, right? So if the interest rate rises, one possibility is that there's a parallel shift. So this is at time 1. This is t equal 1. Now, t equal 0. Now this is t equal 1. So this is called the parallel shift. Can you see? Can you see? Cannot?
Yeah, we can see.
Yeah. So this is called parallel shift, where all the interest rates move upwards in similar amounts. So parallel shift. But usually this will not happen. Now parallel shift means if when interest rate goes up, 1 year securities also go up by let's say 2%, 2 years also 2%, and so on. So that is a parallel shift. But it is not possible always that can happen. Okay. So let me, it's not a parallel shift, let's say it is a shift like this. Now what do you see? Is it same like what you saw earlier? Is it same or different?
It's different.
Different. Because the longer tenor securities increase is higher than the short term securities. So it's much steeper. Much steeper. Right? Much steeper. So then, this is what I refer to the yield curve. Please. So the shift in all interest rate related, in securities on the balance sheet, assets or liability side may not move parallelly. So that is called the yield curve risk. Also, this can happen. Now, this is little bit different than this way. It can also happen this way. The interest rates have gone up, but short-term maturities price is higher than the long-term maturities price because of the market expectation theory. Because when the market expect tight liquidity or higher demand for money, where liquidity is very tight in the markets, so probably the interest rate price for the short-term maturities will be much higher. And when people believe in the long run there is no demand, so there is no demand for longer-term securities, then there will be a lower price in interest rate, right? So this could happen other way also. Now, when downward shift also, this can happen, right? When the interest rate drops, it may be a parallel drop or it may be a steeper drop. Where different maturities, the drop may be little bit different, right? Clear? So I'll put the downward. Now this is the your yield curve at time equals 0. Now say interest rate decline. This is parallel. Sorry, this does not look like parallel. So this is parallel. So all maturities come down by same amount. But this can also happen this way. So there's a decline, but different amounts. You see. So this is smaller, this is little higher, and this is more. Okay. So interest rate drop, but not parallelly. So yield curve shifting risk arises, right? Or this way. So much higher amount in the shorter term and lower amount in the longer term, but there's a drop overall. Right? So as a result, there could be possible yield curve risk. Clear? Any questions? So we will move on to the next day, the next part. So we know repricing risk, yield curve risk, then basis risk. Now another important source of interest rate risk arises from imperfect correlation in the adjustment of rates earned and paid on different instruments with otherwise similar repricing characteristics. Now, interest rate change, these differences can give rise to unexpected changes in the cash flows. And earnings spread between the assets and liabilities and balance sheet instrument of similar maturities or repricing frequencies. Now, for example, a strategy of funding a 1-year loan that reprices monthly based on 1 month US Treasury bill rate. Now, when the interest rate, now let's say, you fund using a 1-year loan, okay? The funding strategy is you reprice monthly reprice based on a US Treasury bill rate. Okay, but a deposit which was mobilized is repriced based on a LIBOR. You see, now let's say you raise 100 million deposit, okay, and you pay monthly interest. You pay monthly interest on that one deposit, 100 million monthly interest, but rate you pay is, let's say, LIBOR plus 1, right? LIBOR plus 1. Then you give that 100 million to somebody, Mr. X, as a loan. Then loan again, interest rate to be paid monthly, but interest rate is based on US Treasury bill rate. Let's say Sri Lanka Treasury bill rate. Okay, let's say Sri Lanka Treasury bill rate plus TB plus 2%. Deposit you mobilize at, let's say, SLIBOR plus 1%. Then what happens? When the interest rate changes, not every benchmark rate affects simultaneously. You see, the treasury rates may not go up in the same manner like LIBOR rate goes up. Or treasury rates may not go down in the same manner like LIBOR rates come down. So there is a mismatch. So even though you asset and liability matched in terms of maturities, but due to the different pricing methodology, still there could be a possible difference that could result in interest rate risk. Got it clear? Any questions? So, so we were talking about the basis risk. A basis risk, is it clear?
Yes, sir.
Okay. So it's basically when even though you match your maturities of assets and liabilities, but when you pre-price using different, scenarios, like one asset is pre-priced using treasury bill plus one, let's say some percentage, but liability is pre-priced using LIBOR plus some percentage. So when the interest rate changes, treasury bill may not move same as the LIBOR. So then again, there could be even the matching asset and liability, this risk can come. Okay. So the final one, optionality. Now we looked at repricing risk, yield curve risk, basis risk. The final one is the optionality. Now what is optionality? An additional and increasingly important source of interest rate risk arises from the options embedded in many bank assets, liabilities, and OBS means of balance sheet portfolios. Okay. Formally, an option provides the holder the right, but not an obligation, to buy, sell, or in some manner alter the cash flow of an instrument or the financial contract. So option may be standalone instruments such as exchange traded options and over-the-counter options. We will discuss those options later. What these options are, there are different types of options, standardized, exchange traded, over-the-counter options. But generally, what do you mean by option? Now, sometimes on your borrowing instrument or lending instrument, I don't know in Sri Lankan context, do have, there is a option of, now I am not referring to this option, but option means a opportunity given to the either party to now let's say I'll take example. Now you issue a debenture, or you invest in a debenture. Now your bank invests in a debenture issued by another company. Let's say John Keel's Holdings issue a debenture, and you invest in such a debenture. But in the debenture, there is a call. Now let's say that this debenture maturity is 5 years. So you will get annual loan, semi-annual interest. At the end of 5 years, you get the total maturity proceeds. But there is a clause in the debenture which says at the end of the maturity, before the end of the maturity, after 3 years, the issuer, now issuer is who? John Case. In this case, John Case. Assume issuer has right to recall the debenture. Right? So recall the debenture means issuer can settle the value after 3 years to the investor and get the debenture back. Instead of waiting for 5 years, issuer will settle after 3 years, anytime after 3 years. So that is embedded option, which gives the issuer right to get it back. Clear or not clear? Is it clear? Not clear?
Clear, sir.
Clear. So then what happens? Now say you invest in this debenture. Now you are the bank. Now you have invested in this debenture issued by the John Case. Let's say Ceylon Bank. So our, participant from Ceylon.
What is the advantage of investor?
Sorry? I couldn't hear. I couldn't hear you. Some question, isn't it? Can you, there's a question or some expressions by someone? Okay. So you are the investor in this debenture issued by, John Case. Then let's say immediately after 3 years, John Case come and say, okay, I want to pay your money and take back the debenture. right? Now, let's say your debenture, the invested debenture for 5 years, you invested as a matching of your liability, okay? Let's say debenture was issued at 10% interest annually, let's say annually. So after 3 years, now usually why a issuer, now this can happen both ways, but I took the example of bank is investing in a debenture, right? It could be another way that bank also issue a debenture, bond, subordinated bond, like what you all do to raise funds. So generally, what do you think? Under what scenario issuer will use that option? What do you think? Now John Keels have this option. Under what scenario probably John Keels would use that option? Instead of waiting for 5 years, they may settle the investor after 3 years or 4 years.
Interest declining scenario.
Sorry?
Interest declining scenario.
Interest rate declining scenario, because he will want to get the benefit of interest rate decline.
Yes.
Provided he has cash to settle. So he may use that option. Now you are the investor. Now your perspective, what is the scenario? What happens to you then? Tell me, other part. There's
Will
someone.
be losing. Investor will be losing.
Sorry?
Investor will be losing.
I mean, can you explain losing in the sense what now relate to our topic?
Because
Give me a minute. If there is a noise coming from someone's, please unmute if you are, when you work from home, please unmute, please, because otherwise it's not clear. So tell me, okay.
because the market interest rates are rising. So
Rising,
no,
but you said
it's a downward
Yeah.
trends, but you
Yeah.
have already invested in a higher interest rate product. So you can gain higher interest from what you have than investing now.
Okay.
So because of that, the investor
So what
will
is that
lose.
called? What is that called? We have learned. What is that called? What is that risk called? We have already learned. Anybody else? This question is open to all. I think we can hear some internal noise of, I mean, other than who talking now, please others unmute. Sorry, mute, wrong word, mute. Anybody else? What is that risk called?
Reinvestment risk.
Exactly, reinvestment risk. Because the issuer will exercise that option, because the issuer has the option now. Issuer has the option to recall the bond immediately after 3 years without waiting 5 years. So now issuer has exercised that. He will exercise only at a time it is beneficial for him of a declining interest rate. So what he do is, he will immediately withdraw, settle your funds, so investor will get money. But for the investor, disadvantage is, now let's say you invested at 10%, now market interest rates is going around, let's say 7 to 8%. Now these excess funds, now you have to invest in a somewhat comfortable instrument. So definitely you have to invest at a lower interest rate, reinvestment risk arises. Okay. So that is called the optionality. Now this could be otherwise also. Now when you issue, now most of your banks are issuing subordinated term debt. How many of your banks, have not issued subordinated term debt? How many of your banks have not issued any subordinated term debt? I don't think so. Commercial bank, let's ask someone from commercial bank. Have you issued subordinated term debt? Commercial bank, someone from commercial bank. I saw several when we discussed in the morning. Have you issued subordinated term debt? I'm not referring me yesterday or day before, but
Debentures we have issued.
yeah, debentures in the basically you call it subordinated term debt, right?
Yeah.
Because you take most of your banks take that into tier 2 capital, right? Okay, Sampak Bank, every bank, most of your bank issued at least couple of subordinated term debt over the last 5 years, definitely, because one reason is to take into tier 2 capital. Okay, tier 2 capital. So when you issue also, you can put an embedded option as a issuer. That's a call option, right to call. Okay. Similarly, issuer can put an option which benefit the investor also. So it could be a call option, it could be a put option. Right to call back or right to sell back. Right? So, but what you need to understand is, so as a result, there is possible interest rate risk. So typical core components of interest rate risk could arise from repricing mismatches, yield curve. The shifting of the yield curve may be different. The basis risk, your asset is priced at a different way compared to your liabilities. So then there could be a basis risk, and when there are embedded options in financial instruments related to interest rate, then definitely there could be possible interest rate risk, right? Anything you need to clear about? Okay. If not, we'll move on to the models to measure interest rate risk. So we are going to discuss 3 models in our course: cumulative gap model, the maturity gap model, and the duration gap model, right? So those are the 3 areas we will focus on this particular program. Now let's move on to the cumulative gap model, also we call the repricing model. Now what do you mean by repricing model or the cumulative gap model? Now in the repricing or cumulative gap model, we use a very simple analysis of assets and liabilities in the balance sheet. So there is no complexity. Simply we focus on the book value of assets and liability, that is balance sheet, as at a particular date, and look for future repricing requirements in terms of both assets and the liabilities. So we call when you say repricing, we have to identify a particular time period and we have to identify RSA. RSA stand for rate sensitive assets. Then we have to identify RSL, which stand for rate sensitive liabilities. Okay, so that's a very simple way. So you take a particular point. Now let's say today you want to look at 3 months repricing gap. 3 months, next 3 months. Now let's say today we are on 12th of September. Your risk manager wants to identify the risk repricing gap of your asset and liabilities over the next 3 months period. 3 months period. So the repricing gap equal to the assets which are repriced over the next 3 months minus liabilities which are repriced over the next 3 months. So when repricing means we call those are rate sensitive assets. Because repricing means you have to adjust the interest rate. So that is a rate sensitive. Not all assets are repriced within a particular period. Even interest rate related, not everything is repriced. That's why it's very important when we talk about repricing gap, we need to identify a particular time period, future time period. 3 months, 6 months. Now there may be asset which will reprice in 5 months, but if you look at the repricing gap in 3 months, we will not consider that asset because for your period, that will not be repricing asset, but interest rate related. So the important word is assets which are repriced within the or during the given future time period. So these are called rate sensitive assets. Similarly, we identify assets which are going to reprice over the identified future period, let's say 3 months. Then the difference between RSA and RSL is called the repricing gap, right? Repricing gap. Depending on your structure, the gap may be positive, gap may be negative. Depending on the structure, gap may be positive, gap may be negative. If we have a positive gap, that means you have more rate sensitive assets than the rate sensitive liabilities. If we have a negative gap, that means your rate sensitive assets are less than the rate sensitive liabilities. So the gap, whether the gap is positive or negative, decide your impact as a result of interest rate movements. Okay. So when you have a positive gap, when the interest rate rise, it has one impact. When you have negative gap, interest rate rise will have a different. Similarly, when the interest rate decline. Now, this is a very summary version of impact I have given in the table. Now, this is a small formula given. Now, NII stands for net interest income. Now, ultimately, what we need to do under this model is to estimate any possible interest rate rise or decline on the net interest income over an identified future time period. Right? So that is the overall object. So the change in net interest income, there's a small I means the I period, that is 3 months, 6 months, 1 year, equal sum of gap I, okay, sum of gap I in the gap during the cumulative gap during that period into delta R stand for change in interest rate, either positive or negative. I mean, in more simple terms, change in net interest income. Now, change in net interest income measures the impact. Equal, RSA minus RSL within that particular time period into change in interest rate. Okay. So we can think of 4 scenarios, 4 possible scenarios. And then we can think of the income impact on the net interest income. Right? Okay. So let's move on. The first row. Gap is less than 0. What do you mean by gap is less than 0? Anyone? What do you mean by gap is less than 0?
It's negative.
Yeah, but what do you mean by that? It's negative, but what do you mean by that?
Asset sensitive liabilities are more than asset sensitive assets.
Okay, I couldn't hear you clearly. Again, can you repeat it?
Asset sensitive liabilities are more than asset sensitive asset.
Okay, rate sensitive, okay.
Asset.
Rate sensitive liabilities are more than rate sensitive assets. Right. So gap is negative or less than 0 means you have more rate sensitive liabilities than rate sensitive assets, or rate sensitive assets are less than rate sensitive liabilities. So if you have a negative gap, then go to the second column. Delta R is less than 0. What do you mean by that? Anyone can think of? Any possible explanation? Delta R less than 0. Anyone can guess? Some of you are in the risk area, so probably you know what do you mean by that.
Is there an interest rate reduction? It's that mean?
So what is delta R is the change in interest rate. So change in interest less than 0 means that's a drop in interest rate. Okay, so delta R less than 0 means interest rates have declined from the current rate, right? So what does it mean? If you have a negative gap, that means you have more rate sensitive liabilities than rate sensitive assets, and interest rate decline, what would be the impact? That is, change in net interest income is positive, greater than 0. What do you mean by that?
Entity will get, the business unit will get the income. Net interest margin will.
Sorry?
Net interest margin, net interest income will increase.
Increase, okay. So basically, what does it mean? If there is a negative gap and the interest rate declines, the bank would end up with positive impact on net interest income. That means net interest income will go up. Clear? Clear? Is it right? This is what this table says. So what I'm asking is, fundamentally, is that right? I mean, table is something, this is mathematics ultimately. But how it can happen? That is the most important thing. This is right, this is happened. This will happen, this is happening. So no argument of it. So what could be can you find someone, I think many experienced bankers in this group, can at least someone explain it?
It is due to the repricing of the liabilities. Because if the rates are going down, we're having a more rate sensitive liabilities.
Yeah.
In that case, when the repricing, we reprice for the lower rate, but our assets are compared to the sensitivity, it's a bit low, then the rates are a bit higher. In that case, we have a net interest income is positive side on it.
Okay, so you came, somewhat, you gave a somewhat comfortable answer. So when you have more rate sensitive liabilities means you have to reprice your liabilities at a shorter interval than the rate sensitive asset because you have more liabilities in that particular time period. So when the interest rate drops, what happens? You reprice those liabilities to your more liabilities now immediately than the assets. take example. You have 10 million rate sensitive assets, but 20 million rate sensitive liabilities within next 6 months period. Let's say 6 months. 10 and 20. So immediately when the interest rate drops, you are repricing 20 million of liabilities at a reduced rate than the 10 million assets. So you have more liabilities. So benefit coming out of repricing of liabilities as a result of declining interest rate is far more than benefit coming from, or maybe, whatever, there is no benefit, but what you call asset side. Okay. So that means you end up with a positive net interest income. So let's move to the second row. Still you have a negative gap, that is, you have more rate sensitive liabilities than rate sensitive asset, but your interest rate change is positive. So what do you mean? Interest rate pricing scenario. So gap is negative like earlier case, but interest rate rising scenario, in such a case, there will be a negative impact. But it's the same. Now you have to face the other scenario. Now interest rate rising. So you have more rate sensitive liabilities means you have to adjust your deposits at a higher rate because you have a higher amount, so that the impact is much higher than the adjusting the what you call assets, because assets have lower. Then you have a negative impact. Then let's move on to the third scenario. If you have a positive gap, now you have a positive gap. Okay, I'll move on to the last one and come to the third one. Last row, you have a positive gap. So what do you mean by positive gap? You have more rate sensitive assets maturing in that particular period than the rate sensitive liabilities maturing. Okay, positive gap. When you have a positive gap and let's say interest rate rises. So when you have interest rate rises and positive gap means that you have more assets which are repriced at a higher rate than liabilities repriced at a higher rate. So it will be a positive impact. So you end up with a positive result. So it opposite happens when you have a positive gap but interest rate decline. You have a negative impact. So this is broadly what happened for any financial institution when the interest rate goes up or down depending on the gap they have. So this is a very basic, simple model many banks use to assess future interest rate risk based on the possible changes of interest rate. This means the impact on net interest income based on the possible future interest rate moves, right? Now we'll take a very simple example how this will take place. Now very simple example of a simple balance sheet. Now we have rate sensitive assets 500, rate sensitive liabilities 600. Now on rate sensitive assets, our yield is 8% and rate sensitive liabilities, our cost is 4%. Then we have fixed rate assets. Fixed rate asset 350, the yield is 11%. Then there are fixed rate liabilities, yield is 6%. Then non-earning assets 150 and other liabilities 100 and equity 80. So the total balance sheet 1000 assets and liabilities and equity 1000. Okay. Now, let's do a very simple calculation. Don't worry about complex gap calculation. Let me show you. Now, what is the net interest income of this particular bank? Can someone calculate? I have given here, very simple, annual income. Bank would get 8% from this 500. Bank would get 11% from this 350. Non-earning, that means you don't get anything. On liability side, you have to pay per person 4% to this 600 and 6% to this 220. Then there are other liabilities, you may not pay any interest. So basically, your net interest income as it is from this bank is how much? 41.3 million or rupees or whatever. And your margin is net interest income divided by the assets. Okay. So that is here the earning assets, average earning assets, 850. So it's 4.86%. So the bank's net interest margin is 4.86%. And what is the gap? Now gap is, now let's say this is 1 year period, RSA minus RSA. So the bank has rate sensitive assets 500, rate sensitive liability 600. So the bank's gap is negative 100, right? So this is the picture as it is in this particular bank, right? Don't look at the answer. Now let's say interest rate changes by 1%. Okay, change means 1% increase. 1% increase. That is 1 year rates would rise by 1%. Right? 1 year rate would rise by 1%. Can you all calculate these numbers? Don't look at anything. Same way, calculate these numbers. That is net interest income and net interest margin. Can someone calculate? Don't look at the answers. Probably you, I think this one has been shared with you, but don't look at, but simply calculate. When the interest rate rises by 1%, what is the impact? Can you all do this? Take about 5 minutes. Anyone did completed? Same as here? Anybody completed? What is the net interest income? What is the net interest income now? New one?
New one is 40.3.
40.3. Okay, let's have a look. Okay. So very simple. Now interest rate rise of 1%. So that means our rate sensitive assets will go up to 9% and rate sensitive liabilities will go up to 5%. What about fixed rate? What about fixed rate assets?
No change.
Because these are not rate sensitive, no impact. They remain same. This 11 and 6 will remain same. So now we get 9%, because earlier 8%, 9%, earlier 5%, sorry, 4%, 5%. This 11 and 6 will remain same. So redo the calculation, we'll get 9% out of 500, 11% same from 350 minus, we have to pay now 5%, 1% higher for 600 and 6% for this 220. So our net interest income is 40.3. So what has happened? And also the margin now has come down to 4.74 compared to 4.86. So what is the reason? What is the reason? Now, why we had a negative gap? What is our negative gap? Rate sensitive assets 500 minus rate sensitive liabilities. we have a negative gap, but what sort of interest rate change we had? What sort of interest rate change?
Positive.
Positive.
Positive. So we have a negative gap. Yeah, negative gap, this one. Positive interest rate change. So what would be our end result? Should have a negative impact. That means net interest income should decline. We saw it. Net interest income declined by, let's say design millions, 1 million. So it was earlier 41.3, now 40.3. So we can now, we work this using the normal, but we can use this model without doing this thing. Now, how do we use the model? Can someone tell?
Gap is minus 100. And,
Minus 100
delta
into?
R is plus 1. So minus 100 into 1 is 1% is minus 1.
Yeah, 1% means 0.01.
Yes.
Yeah, because if you go to the formula, your gap is minus 100 times change is positive 1%, that means 0.01. So minus 100 into 1% is negative 1. So your impact is negative 1 million. So that means from your original position, there is a decline of 1 million. So new position is 40 points. It's very straightforward. Any questions? So the important method which you can derive as a banker from this model is, now this is a model which is dynamic. In your risk management tools, as a part of your risk management tools, when you have this repricing gap model, every day the bank can come up with a number for any desired period of time for future for possible interest rate impact based on the bank's expected future scenarios. Now, if the bank expect there's a possibility of interest rate can go up by 1% over next 1 year or maybe 6 months, so bank can plug in those numbers and look what is going to be the impact if that happens. So that gives some feeling about your risk. And then you can, now why we do all those things? Just for the fun? No. Okay, now we say, okay, 1% interest rate increase would result in 1 million and just waiting. No, we are risk managers. We can't wait, we can't sleep. We have to act accordingly. If you estimate 1% interest rate, you have a 1 million impact, but in terms of your earnings yield, 4.86 has come down to now 4.74. Now, very simple example. Now, the situation may vary depending on the size of gap. Now, it's a very marginal 100 million gap. Let's say you have a gap of 10 million. Situation would be much worse. Situation would be much worse. Right? So then you can restructure your balance sheet appropriately to minimize the risk. Minimize the risk. Right? So this is something we have a statistician. I think in this group we have a statistician. I think there was somebody said I am doing analysis for data. So this is something a statistician can do is, you can plug in numbers based on your model and see different types of impacts. And when you submit your data analysis to the management, of course, it is the duty of the risk managers to take appropriate measures. We can't do everything. We can't completely avoid risk, but at least we can have some sort of measurement depending on the risk priority, the impact and the likelihood, right? So this is again a very simple example. Is repricing gaps. Now 1 day gap, 1 day to 3 months gap, 3 months to 6 months gap, 6 months to 1 year gap, 1 year to 5 year, more than. Now usually when we look at repricing gap, now we focus very short term. I mean, no one can predict longer term, right? So generally when we talk about repricing gaps, we usually talk about up to about 1 year. I mean, we can compute the gap, but generally the gap significant up to like 1 year. Because we cannot, one thing is, more than 1 year, it's very difficult to predict. But no point also discussing more than a 1 year period, because every time changes can take place. So the ideal scenario, max 1 year repricing gap. So in this is example. Now you have rate sensitive assets 20 during next 1 day period, and rate sensitive liabilities 30, your gap is negative. Now C gap means the cumulative gap. 30, 40, you have negative 10, this negative 10, this negative 10, negative 20. 70 minus 85, negative 15, this minus 20 plus this minus 15, cumulative 35. 6 months to 1 year, you have 9 to 2, 70. So you have a positive gap, minus 35 plus 20 minus 15. So that means the cumulative gap over the next 1 year period is negative 15, right? Negative 15. So if you want to estimate 1 year impact on your net interest income due to whatever the interest rate increase or decrease, you can use the repricing gap formula. So let's say, so what is the impact this bank has as a result of 100 basis point increasing interest rate over 1 year period? So the total negative gap, total cumulative gap over 1 year period is negative 15 multiplied by 100%, 100 basis point means 1%. Bankers, basis points for 1%, we have 100 basis point, right? So 100 basis point increase means how many percentage? 1%. When you say 50 basis point increase means what?
0.5%.
0.5%. 25 basis point increase means 0.25% and so on. Always 1% equal 100 basis point. So 100 basis point means 1% minus 15 into 1%, that is 0.01 in decimals. So the negative impact would be 150,000. So you see how useful this model, repricing gap model, for any banker to estimate risk, for probable risk that would result as a result of changes in interest rate, decline upwards in any quantity. Any questions? Anything you need to clarify?
So I have a small question that under this present low interest rate regime, is it advisable for us to canvas more long-term deposits when considering the repricing?
For long-term deposits.
Yeah.
Okay. Yes, one way, because now again that all depends on your structure on the other side as well. But if it is, when a environment, when you operate in an environment very low interest rate, if you can mobilize longer term deposits, always you have a positive impact, because your repricing need not happen immediately. Now, when you are in a very bottom line of interest rate environment, that there are two possibilities, no? Depending on whatever interest rate environment, from today's point of view, in future, one possibility is to go up, one possibility is to go down, or one possibility is to stay stable around that range. So there are three scenarios. Of course, three scenarios remain same, go up or come down. So when you are in a bottom, always the opportunity is either to stay around that range or to go up in any market. Even if you take a equity market, stock market, when you are at a very high peak of indexes, then the more opportunity is to come down rather than going up. So similarly, when your equity markets are at a probable low level of indexes or P ratio, then more opportunities is to go up than coming down, because lower P ratio. Similarly, interest rate, very, very low interest rate, because there is no way that, rather than no way, let me put this way, in probabilities, we are talking about risk. When we talk about risk, we have to talk about probability. So when in a very low interest rate regime, if we are in a such regime, the probability, I'll put it in risk term, there's a greater probability, let's say 90% probability to go up and only 10% probability to come down further. So that means you have a greater probability that going up. So if the probability of, that is the likelihood in terms of risk likelihood, in such a case, better lock in for a longer term funds. Because when you lock in for a longer term funds at current levels, if the interest rate goes up, you don't have to reprice immediately. Okay. And also you can match with your longer tenor assets. So this is possible risk management. But again, you have to look at other factors in your bank which requires such a long-term funding. You may not require long-term funding forever. Now, let's say you are a bank operating with more long-term loans. Now, this is especially good for a housing bank. Because housing bank, you are long-term than a normal commercial bank. Because your assets are more long-term, 5, 10, 15. So then you match with the long-term liabilities. So it is a good opportunity. So all these need to be, but generally good, I agree. Clear?
Yes, sir. Okay.
Any other questions? Okay. So let's move on to the next item, cumulative gap ratio. Now, this is a very important risk indicator for many banks. Now, when I say banks, I refer to banks and financial institutions. Okay, Ripa? So always I come to my mind bank, but refer to bank, finance company, anybody in this sector, right? Because we have a couple from MBSL and CDB as well, right? So C-gap ratio is a measure of risk management. Now, C-gap ratio is defined as cumulative gap divided by total assets. Now, what do you mean by cumulative gap? Let's say if we talk about a 1 year risk indicator. Now, in this particular bank, cumulative gap is 15 divided by 260. 15 divided by 260. Okay, so cumulative gap over a particular period. Now, this is a risk indicator. Now, if you discuss with your risk people in your bank, you have set some C gap limits. Or probably discuss with your colleagues in the bank if you are not in the risk department. So this is definitely a commonly used measure, C gap. So the bank sets based on the risk tolerance. Now, what is the important thing? We are living with risk. We cannot completely avoid the risk. If you do, now very simple is when you give a loan, whatever assessment you do all the financial, everything, you are taking a risk. Even the very best customer you thought could default. I'm not saying default, could default. Due to many factors which you couldn't detect or which is even beyond your control, beyond his control. Okay. Now let's say a very classic example. Now yesterday we saw, I think all of you saw that what happened in 2001 in US. So let's say this particular big building, there's a real estate owner who erupted building. Take example. Now what happened? 2 towers completely burst. So let's say this building was, built up using obtaining some loans from, some US international banks. So what is the scenario? He was getting good income, he was repaying. What he can do now unless he has any other income? So when you gave the loan to, construct this particular towers, he has been a good customer, everything fine, but this is rather unexpected. Completely burst. So no way. Immediately, let's say his sole income was derived from this. So what is going to happen? No way. So that is the risk. That is the uncertainty. No one could predict that. That is the danger, So never ever think, we never can predict what is going to happen next moment of time. Next year, 1 year, next. So that is very dangerous in your term. So what it tries to do is, okay, bank set a limit, C gap, okay, this is the maximum tolerance. So that I must try to maintain my gaps always around this region. So let's say my C gap ratio is 15% for the next 1 year. So what I try to do is any adverse gaps, I should be maintaining around that range, not around, below that range. So any adverse, let's say there's a possible, gap which could arise. Okay. Now usually adverse gap of let's say 15%. That depends on the bank's tolerance level. I remember I told appetite, attitude, all those factors when you set the limit. So your bank, let's say Bank of Ceylon. So Bank of Ceylon said my C gap is negative, maximum tolerance is 15%. Either way, the possibility. Right? So the idea is, whenever you set a limit, when you see in reality, now this is the theory. Like you set a limit, theory. But in practice, your books, assets, liability balances, interest rate changes. When you see at a particular time, your gap is going to be exceeded, then you use the alarming signal. That is like, now today's many, technology-driven vehicles, you can set the, set the speed limit, right? Say, now your risk measurement is, you feel today it's a rainy day, I should not go beyond, let's say, 70, at the race. But when you drive, very difficult because you can't control. But then you set the 70, always it will stop at 70. Or sometimes, if it's going to increase the 70, it will give a signal. If you can't set the limit, at least it will give a signal. Okay, now you are reaching 7. Then you have a control, right? So whenever you see gap, cumulative gap is changing adversely compared to your C-gap ratio, then it is an alarming signal, right? Okay, so let's stop there for a little break. And then, okay, we'll finish this because it's related to the C-gap. Okay, this is just an example to explain the C-gap. So you have a balance sheet like this. Okay. Short-term consumer loans, long-term consumer loans, treasury bills, 3 months, 6 months, 3-year treasury bonds. 10-year fixed rate mortgages, 30 years floating rate mortgages. Then demand deposits, savings, 3 months CDs, 3 months TDs, 6 months commercial papers, 1 year TD, 2-year time deposits, equity. So 270. So compute the cumulative gap and the gap ratio for 1 year. Cumulative gap and the gap ratio for 1 year. Can someone compute the possible rate sensitive assets for 1 year, this particular case? Can someone compute and tell? Right? Can someone compute? Possible rate sensitive. Don't look at the answer, but compute. Looking at the nature of the instrument and maturities, you should be able to do this. With the limited information, of course, not much information. So guess certain things. Anyone computed RSA over 1 year period? No? Okay, take about a couple of minutes, think. RSA and RSL. RSA, please. Anybody got any answer?
Is it 155 million?
Yeah, how did you get, if you could explain, please?
Short-term consumer loans 50 million.
Yeah.
And 3 months treasury bill 30 million, 6 months treasury bills 35 million, and 30 years floating mortgage.
Floating rate mortgage. Okay. So everybody agree with that? Now, what do you mean by RSA? The assets probably which is subject to the repricing during a 1-year period. Now, short-term loans, usually we classify the loans maturing within a 1-year period. So definitely at the maturity, they have to reprice. So no long-term loans. Then 3 months treasury bill, definitely maturing within 3 months, maximum 3 months, depending on when you purchase. So that need to be repriced. Then 6 months treasury bill, again maturing before 1 year, then definitely it is repriced. 3-year treasury bonds, we have not been told about any interest rate adjustments, so we can ignore that. 10-year fixed rate mortgages, anyway fixed rate, so we don't have to consider. 30 years FRM is floating rate mortgages. Floating rate means you have to adjust the interest rate, usually semi-annually or annually. So that is again subject to interest rate change. So that possible RSA elements are 50 short-term consumer loans 50, treasury bills 3 month 30, 80, 6 month treasury bill 35, that means 115, and the last item 30 years floating rate mortgages around 40. So the rate sensitive assets over the 1-year period would be around 155 million, so which are subject to repricing. On the liability side, anybody could work the numbers? Don't worry if you make mistakes. There may be certain, but this is not we don't have much information, so definitely your thinking may be a little bit different. So I would rather say demand deposit anyway, we don't pay any interest on demand deposit, so this is not rate sensitive. Now savings deposits, now if you look at savings deposit, now usually savings deposits, unless there is a significant changes, over a period, usually you don't adjust. Usually you don't adjust. So we can assume these are not rate sensitive. Not like the time deposits. Of course, if there are significant interest rate ups or down, you have to adjust. But generally you keep, savings rate at a pretty low. And so usually you don't do significant adjustments in the very short run. But of course, when let's say interest rates about let's say 10% and some coming down, it comes to 5%, definitely you will adjust. But usually, since their savings rates are kept at a very low rate, but of course in Sri Lanka sometimes we pay higher rates, but generally savings rates are usually kept at a very low rate. So that changes would be minimum unless there's significant increase or decrease. So we will leave savings deposits. Then 3 months TD is definitely 40. 3 months TD is definitely 2060. Commercial papers, yes, 60. Then altogether 120. And 1 year TD, 2140. 2 year time deposits, we haven't been told that, whether it's floating, the floating rate deposits. So that means we can assume fixed rate. So basically 140. So your gap is around 15 positive, 155 minus 140. So possible impact of the interest rate increase by 1%, you have a positive income. Because now your gap is positive, interest rate increase is also positive, you end up with a. So your gap is positive, interest rate increase of 1%, so you end up with a positive result of net interest income. So that means you will end up with 150,000 positive, that is increasing earnings. So net interest income will go up by 150,000. So your gap, C gap ratio is 15 divided by 270. Okay. So 270 or 260. 270, yeah, 15 divided by 270. That is 5.6. Okay, so let's say you have a, gap ratio. This is the actual gap ratio. You have a target gap ratio is 15%. So either way, you don't want to maintain it's above 15%, on either side. So in this case, if your target is 15%, you have a 5.6% gap, so you are within the target. Right? So you are comfortable. But let's say your target gap is, somewhat, so your gap is above the target gap. Sometimes there may be a downside risk if the opposite happens. Now, this is, of course, you won't have any problem because of a positive impact. But if it is a negative impact, like interest rate decline by 1%, then you will have a problem. Okay. So you have to look at target gap and your actual gap from, where you stand with the interest rate increase or decrease. Right. Okay, we'll since we have some more to go in this, we'll stop here for a tea break. Okay, so let me move on to the next part. Next part in the sense continuation. Now, what are the importance of cumulative gap ratio? Before that, any questions anybody would like to ask? No, okay. Now, cumulative gap ratio basically establish the direction of interest rate exposure. Now, so it tells where we are heading. Okay, so what would be the interest rate risk exposure and the magnitude. Okay, magnitude. The larger the absolute value of the C gap, the larger the expected change in net interest income. So it provides the direction where we are heading and also tells about the magnitude of the risk exposure and provide a crude estimate of the income impact of the change on net interest income. So as you know, the cumulative gap, the actual gap will provide an estimate of the impact of change in net interest income and used for peer group comparison. Now, Again, one way of looking at is now you can compare with other peer similar banks, Now, say you are in a banking industry with certain size and certain features, so probably you can compare, let's say, Bank A can have a look at what is the cumulative gap ratio of Bank B, which is more or less similar to business of my bank. Then also historical series can be subjected to econometric analysis. Our statistician can do this econometric analysis and used to estimate banks' views of the direction of interest rate changes. Now, using statistical analytics, here we call econometric analysis and forecasting for future different interest rate scenarios, then probably you can have a different scenario analysis of the movements of interest rates and the resultant, impact of the net interest income, right? So let's look at the directional impact, the impact of C-gap, changes in interest rates, revenue, expenditure, and the expected value, okay, and assuming equal changes in RSA and RSL. So if you look at a positive C gap, that is cumulative gap is positive, and if the interest rate change is also positive, that means revenue goes up, expenditure also go up, but there isn't positive net interest income impact. So if you have a positive income, C gap, but interest rate decline, the revenue go down, expenditure go down. As a result, net interest income will go down because you have a higher, the gap is positive. Then if you have a negative gap, C gap, interest rate and increasing interest rate, then revenue goes up, expenditure go up, but you have a negative net interest income impact. Then if you have a negative C gap, but interest rate decline, that is delta is less than 0, then revenue comes down, expenditure come down, but you have positive net interest income impact, right? So this is basically what will happen to a bank's net interest income whenever you have positive or negative gap and possible interest rate increase or decrease, right? So you can run any models under these four scenarios. That is, you have a positive gap, and then if the interest rate rises, what is going to happen? And the interest rate decline, what is going to happen? And if you have a negative gap, what is the impact if the interest rate rises, and what is the impact interest rate comes down? Okay, so that is the way that risk managers can look at the different impacts arising from movements on interest rates, right? Now, all this time we took when we used the model. This model, we assume both the change in interest rate for both assets and liabilities, that is rate sensitive assets and liabilities, are same. Okay, so when the interest rate increase by 100 basis point, mean both RSA increases by 100 basis point, RSL increases by 100 basis point. Or if it decline, both decline by the same amount. But let's say it is not same. Okay, so the directional impact with unequal changes. So that means, let's say assets, there's an increasing environment, interest rate, let's say asset rate increased by 1%, but liabilities increase only by 75 basis point or 0.75%. So it can happen, you know, both assets and liabilities may not shift parallelly, okay, in either increase or decrease. So then the C cap can be modified in such a way, change in net interest income equal RSA times change in interest rate of assets minus RSL times changing interest rate of liabilities, right? So let's take the previous example, the very last example we did of this case. Now here we assume interest rate went up by 1%. Now let's take the same example, but assume RSA rise by 1.2% and RSL rise by only 1%. Then what is the directional impact? So RSA 155, remember we computed 155 rate sensitive assets times 1.2% means 0.012 minus RSL 140 we computed earlier, and it will only increase by 1%, 0.01. So the impact would be 460,000. So that means whether you have equal decline or increase in interest rates of both RSL and RSA, or whether you have not equal interest rate changes, you can compute the impact on net interest income, right? Any questions so far? So let's look at the drawbacks of C-gap model. Now, one of the critical drawbacks of C-gap models, it ignores the cash flow patterns within a maturity bracket. Okay. Now, if you take a longer tenure maturity bucket, say 1 year, but you simply take rate sensitive assets and liabilities maturing over 1 year period. But within that 1 year, there may be significant mismatches, right? For example, let's say over 1 year period, you have a rate sensitive assets maturing 100 million and liabilities maturing 200 million. Sorry, 120 million. So if you look at overall gap, it is negative 20 over the 1 year period. But within the gap, there may be periods which the gaps are significant. So that's why when you look at C gap, if you look at shorter end gaps, it is much comfortable. Right? I don't know whether you understood what I said. Now, for example, let me explain something. Can you see the board? Can you see the board? Right? Can or cannot? So this is 1 year horizon. So if you take whole 1 year, you have 100 million assets, rate sensitive assets, and you have 120 million rate sensitive liabilities. Can see?
Yes, sir.
Yes, sir.
Okay. So if you look at gap, okay, C gap or gap, whatever you call, 100 minus 120, so that means you have negative 20. So within 1 year period. But let's see how this 100 million came. Now let's say, now within, I will dig into 4 components, 3 months, 6 months, 9 months and 12 months. So out of this 100 million, within the first 3 months, there is 20 million assets and 80 million liabilities, right? Or maybe 100 million. Let's say 100 million. Then the balance 3 months or 9 months together, we have 80 million and let's say 20 million. You see? So when you take entire 1 year, so your 100 million is first 3 months 20 plus, next 9 months 80 on the asset side. And when you take liability side, first 3 months 100, second 9 months 20, right? So when you look at the whole year, your gap is negative 20. But if you look at this 3 months, now 3 months gap is how much? Minus 80. So there is a serious gap problem within the first 3 months, which is not captured when you look at the whole 1 year scenario, right? So that's why if you have a longer gap period, the changes within a particular period, inside the period, may not be captured. But which could pose possible risk, you see. 3 months, there's a possible risk. That is the danger. All right. Clear? Any questions? Please ask. Clear or not? No response. Can you all hear or?
Yeah, yes, sir, we are clear.
Whether the explanation is clear?
Yes, clear.
Oh, okay. So I hope at least one told. So it's important that generally you look at the in-between gaps also when you measure a little bit longer period like 1 year, because the difficult part is the 3 months. You know, if there is any significant fluctuations in the 3 months period, definitely you won't counter that when you look at a 1 year period. Probably you will be subject, because you assume 1 year period and you estimate for negative 20 and impact, but really within the next 3 months, the interest rate adversely, ISO come down, then you will have a significant impact, but which you couldn't capture, right? Okay, let me go back to the presentation. Can you all see?
Yes, sir.
Okay. So let me go back to the presentation. So that's what it says. Ignores the cash flow patterns within a maturity bucket, right? And also the second point is ignores the market value effects of interest rate changes, Because here we don't consider any market value effects. We simply take the book values because it is based on the balance sheet asset and liability values at a particular date and look at the future period. Okay, so we don't consider market value effects because market values also can change. In addition to the repricing, there could be possible market value changes if it is in the trading portfolio, right? Fails to deal with the problem of rate insensitive assets and liability cash flow that may reinvested at current market rate and repayments. Now, when we look at this model, we only take rate sensitive assets which are, what you call subject to repricing, liabilities which are subject to repricing. But there may be cash flows which are not rate sensitive but mature, which we need to reinvest. Or there could be prepayments that which we need to refinance, whatever, So that is possible. So that with that, probably we don't capture that, so that there may be a possible margin of error, right? Okay, so that's the basic background behind repricing model. Okay, so it is very important for you all to now, when we estimate the gap under the repricing model, the important things are estimating assets which are rate sensitive and liabilities which are rate sensitive. Not everything now, even the interest rate related assets not all are rate sensitive within a particular period. Now, can you tell me now, a bank has invested in a 3-year treasury bond, okay, the 3-year treasury bond, which pays coupon 6% per annum. 3-year treasury bond, bank has invested, maturing in 3 years, which pays coupon 6% per annum, but coupons are paid every 6 months. Now, let's say it's like this. Okay, bank has mobilized a fixed deposit 3 years. Okay, 2 examples. The bank has mobilized a fixed deposit 3 years. The interest rate is 10% per annum, but interest rate is paid every 6 months. The first one is bank has invested in a treasury bond, not say treasury bond, whatever bond, corporate bond for 3 years, maturity 3 years, but the return will be every 6 months at a rate of 10% every 6 months. So if you take a 1-year bucket, how do you consider this asset and liability? First one is a corporate bond maturing in 3 years, interest rate 10% per annum, but paid every 6 months. Then the second one on the liability side, fixed deposit 3 years, maturing 3 years, interest rate is 8% per annum, but paid every 6 months. So you are in the process of estimating the repricing gap and considering 1-year time horizon for RSA and RSL. How do you take this asset and liability into your calculation? Can someone tell? Can someone tell?
Asset is rate sensitive and FD is not rate sensitive.
Okay, let me ask a question. Why do you say asset is rate sensitive?
Because coupon is paying in every 6 months. So the prevailing rate is paid.
But I said 10% per annum. Asset is earning 10% per annum. Okay, we'll, while keeping your views, we'll ask for others. Okay, we'll take a note of what you said. Others? Anyone? So this is what we are getting. Yes.
Yeah, both are not rate sensitive because both are long 3 years period. We are analyzing for a 1 year period. There is no involvement of repricing. In that case, there won't be a.
You are partially right. So I will explain later after we hearing from others as well. Anyone else? Any thoughts?
So, though they are not rate sensitive, those assets and liabilities for the we are getting cash inflow from coupon, and we have to pay the interest for the fixed deposit.
Okay.
So,
yeah. My question is, are you going to take them in your calculation as rate sensitive assets and rate sensitive liabilities? That is my question. So
coupon and interest paying will be rate sensitive.
Coupon and interest payment. Because we only look at the asset repricing. I know what you want to say. Okay. What about our gentleman? No answer from gentleman yet. Gents? Anyone? Okay. Now here, I'll start from last point. Of course, if you look at the cash flows coming as investment income is subject to repricing. That's right. But when you look at the asset per se, it's not subject to repricing because it's not just the maturity, but at the time during that period, whether interest whatever the payment is subject to any interest rate adjustments. But when you say 10% fixed rate means at 6 months you may pay half of it, 5%, right? But whether interest rate goes up or down, you don't change the interest rate, right? What you paid 6 months before is the one you are going to pay now. Let's say that your the book value or the face value is 1,000, 5% means 50. So you pay 50, which is you paid 6 months ago, and same 50 you will pay within next 6 months, So it's not just the maturity, it's the fixed interest. So similarly, deposit, when you pay 8%, 3 years, whatever happened in the market interest rate, that 8% will not change. So every 6 months you pay 4%. Or let's say your investment is something, same question, 3 years maturity. Your interest rate is fixed, interest is paid 6 monthly, every 6 months, based on treasury bill plus 1%. based on treasury bill plus 1%. So then what happens?
That will
Huh?
subject to that will subject to repricing because
That's
treasury bill rate will
change.
change.
Vary. So that is subject to repricing because interest rate, but let's say when you pay the last installment, let's say on 1st of January, okay, 1st of January, treasury bill rate was, let's say 5%, then you paid 6%. Now let's say after 6 months, 1st of July, you are going to pay. Now treasury bill rate, let's say go up to 8%. Now you have to pay 9%. Let's say TB plus 1. Then you have to reprice then your interest rate structure, income will be affected. Now here, you look at the income impact. But of course, in between cash flows also we ignore because now, as you said, someone told, what about the income you get? Income you get. That is not considered because that is not part of your originally interest related income. Of course, when you invest that in a separate instrument that year, that will be subject to following year's gap, right? But not in that year. Clear? So both these assets and liabilities are not part of rate sensitive asset if you consider a period of 1 year, right? So that is the fact you have to understand clearly. So if there is any question which say compute the repricing gap for this balance sheet, given some information, so you should be able to identify what are the assets subject to repricing, what are liabilities subject to repricing, and what is my gap for a given period, right? Okay, any more questions? We move to maturity model. No, okay. So let's move on to maturity model, which is again another tool or model we can use to manage interest rate risk. Now here, instead of looking at the book values, we look at the maturities of assets and liabilities in a balance sheet from a fair value point of view. Fair value point of view. Right? Now, what do you mean by fair value? Is the marketable value. Because earlier in the model, now remember, these interest rate changes will change the market value also, but we didn't consider that. We simply look at the book values, right? So, the principles of this model, so general principles, a rise in R, that is interest rate, generally leads to fall in market value of an asset or liability and vice versa. So, if there is interest rate rise, market value of the asset or liability fall, right? Interest rate rise, market value fall. That's the first principle. The second principle, the longer the maturity of fixed income assets, larger the fall in market value of any given R increase. So if you have an asset which is longer maturity, then fall in value also increases when R increases. So whenever you increase the maturity, decline in value also increases. But the third point is important. Fall in value of the longer term securities increases at a diminishing rate of any given increase. Now, what is that? Okay, whenever your maturity increases, value decline, but value decline is very slow. Now, for example, let's say you take a 5-year bond, 5-year fixed income bond. The current interest rate is 10%, and interest rate price to 12%. The price will drop. Let's say you take a 15-year bond. Interest rate increase from 10 to 12, again price drop. Then the 5-year bond, the price drop is, let's say, 13%. The 15-year bond, price drop. But okay, let me say 5-year bond price drop is 10%. Then the 50-year bond price drop may around, let's say, 8%. But let's say you take a 50-year bond, then you expect more increase, but it's not. To take a 50-year bond, for the same increase, price may drop by, let's say, 7%. So you see, for the 5-year bond, it's 10%, 15-year bond, it's 8%, but when you go to 50-year bond, it's only 7%. So drop becomes slower and slower as the maturity increase. There is a graph we can show you. So under this model, we look at the fair values and the maturities and try to align maturities of assets and liabilities. Now simply, very simple, I think most of you know this valuation. So very simple. If you take a 1-year maturity bond, the current price is a function of face value, that is the maturity value, the coupon, and the yield to maturity. Yield to maturity is the market required rate of return from the market. So if you take coupon rate is, remember there are two things. When you talk about fixed income securities, there are two things. One is the coupon, other is YTM. YTM is yield to maturity, required rate of return. So those two may be same, different, right? So the price of a fixed income coupon is face value plus coupon divided by yield to 1 plus yield to maturity. So here, the face value 100, coupon 10% means you get 10 out of 100 as your income. Then yield to maturity 10% means 1 plus 10% means 1.1. Your price is 100. So basically, when your coupon and the ITM same, your price equal to your face value. Okay, your price equal to your face value, right? Then let's say your interest rate, that is the yield to maturity, rises to 11%. Rises to 11%. Then what happens? Your face value is changed. We don't change. That is what you get. Your coupon will not change, 10%. But R will change. R will go from 10 to 11. So what happens? Your price will drop. So what happens? Whenever interest rate increases in a fixed coupon bond, okay, your value will come down. Value drops, right? So opposite happens if interest rate comes down. If the interest rate comes down, your value will go up. So it's a inverse relationship. When the interest rate rise, price will drop. When the interest rate drop, price will rise. Okay. So that is the reason last 1.5 years, I think I discussed last time also, many banks who are trading in the government securities or the bonds, in their trading portfolios ended up with massive gains. Especially primary dealers made massive gains. Why? What is the reason?
Interest rates have come down drastically
Interest
during
rates.
the 1.5 years.
Interest rate came down, you see. Interest rate came down means prices should go up. Because interest rate goes up means prices will come down. So now, if you look at the possibility is now rather than interest rate go down, maybe go up. We don't know. So now you have to be very careful that to maintain your trading portfolio at a comfortable level. There's a possible risk, we don't know. Okay. So this is what I explained. Now this is a change in value with 10-year bond, coupon rate 10%. Okay. So if you take a 10-year bond with coupon rate 10%, how the market value changes when under different interest rates. You see? So at 11%, this is the change because interest rate structure for different years, this is how this interest rate rise will, the price of a bond whenever your maturity is 1 year, 2 year, 3 year, and so on. Okay. Now, at the interest rate of it should be 14%, this one. Sorry, other way. So 11%, this is how your price depending on the maturity. 1 year, 2 year, up to 10 years. Now interest rate rise to 14%. What happened? Prices drop. Prices drop like this. Then interest rate 20%, it drops further. And the interest rate moves up to 30%, it drops further. But what do you see? Now if you look at initial maturities, there is a drop is steep here. But as you come to towards the closer of maturities, what happened? Drop is small. Now if you look at this one, now see from first year to second year, drop is like, for second year is like this much. So this much of drop. Okay. But when you say 8th year to 3rd year, drop is like this, very small. So this is the second principle we learn. Fall in value of the long-term securities increases at diminution rate. So as you extend the maturity, value drop is much smaller and smaller. Right? So you start with 11%, then 14% your drop increasing, then 20% further reduction and 30% further. So as the interest rate rises, the value drops, but with a diminution rate as you go on with maturity. Right? Maturity gap. So what is maturity gap? The maturity gap is the weighted average maturities of your bank or financial institutions, assets and liabilities. Now, what do you mean by maturity of assets equal WAI into MAI? Now, WAI means weight of each asset in the balance sheet times maturity of each asset in the balance sheet. So if you take individual asset weight in the balance sheet and multiply by maturity of that asset, you will get the entire balance sheet maturity of assets. Similarly, maturity of liability is equal weighted average liability of individual liability times maturity of individual liability. So when you compute MA and MLA, that is maturity of assets in the entire balance sheet and maturity of liabilities, you will end up with M gap. Now earlier we computed repricing gap, but here M gap, maturity gap. So maturity gap is a number which tells about the risk level. So as per this theory, it says in order to minimize interest rate freeze, if you can manage the gap much closer to zero, in other words, at almost equal levels, then you are comfortable with managing interest rate risk. Right, so maturity gap is maturity of assets minus maturity of liability. So the idea of this model to look at the whole bank maturities and whole bank maturities, whole bank asset maturities and whole bank liability maturities, and come up with gap and estimate the possible impact. Now, this is just an example of maturity gap. Okay, so we have 7 assets and 7 liabilities, very simple balance sheet. So here we have given the market value of each assets and weight and the maturity. So then you can compute the maturity, weighted average maturity is a aggregate of individual MA and WA. Similarly on the liability side. Now take an example of first one, consumer loan 3 months. The market value of those loans has been estimated at 45 million. So this 17% is the weight. Now, if the total assets are 100, this consumer loans represent 17%. Then maturity is 3 months means 0.25 years in years. So if you multiply 17 by 0.25, I think you should get this number. So you can check, I think you should get that number. Right? Yeah, 0.425, 0.43. So this is the multiplication of WA and MA. That is 17% into 0.25. So similarly, if you take second item, maturity is 2 years, weight weighted average is 11%, so you get WAMA. So when you do that for all the assets and liabilities, it's a very simple example. You ended up with total of 5.12. So this 5.12 is the maturity of assets, that is MA. Similarly, you do the same for the liabilities. So you have demand deposits, which represent 44% of your liabilities. Okay, you expect a maturity of 0.25 years. Now, this is something very difficult. Now, if you look at demand deposit, estimating maturity will not be easy. But based on your experience, there may be a number you can derive. Because in this model, we need to have maturity. Theoretically, you don't have any maturity for demand deposit. So it has come up with a 0.25, then passbook saving, 0.75 and so on. So similarly, you do WLML, come up with total ML of 0.775. So the maturity gap equal 5.12 minus 0.775, 4.34, right? Clear? Any questions? No problem. Okay.
So,
Yes.
if the maturity gap is long at the period, then is
Maturity
it
gap
conducive?
is, maturity gap is,
if it is more and more, is it a conducive point, sir? Is it something very good for the bank, for the industry?
from interest rate point of view, not good. Gap is increasing means not good from interest rate risk point of view.
Yeah, right. Yes,
Right?
can understand. It should be very short, no? It should be very short, then only.
Very short. Then only interest rate risk point of view, you are happy.
Thank you, sir.
The idea is to minimize gap, not to extend the gap. Okay. Okay. Let's move on to the example. Now take a very simple, I always use very simple example for the explanation, but if you look at a real bank balance sheet, I mean, you will get confused, but for explanation purpose, otherwise you will get confused when you explain. Very simple structures, but in your bank, you don't have this very simple one asset, two liability, one liability balance sheet. It is a huge balance sheet of number of assets and number of liabilities. But today, when you fit all those into a model, it will automatically provide the numbers. So you don't have to worry whether you have 1,000 assets or 10,000 liabilities or whatever, because through the computer generated models, these numbers automatically will come and you have to only analyze the numbers. But for explanation, I'll take a very simple example. Take this very simple balance sheet, one asset, one liability. Now, asset value is 100 and maturity of that asset is 3 years, right? Very simple. 3 years, asset will mature in 3 years. There's a liability of 90, which has a maturity of 1 year. And the bank has equity 10, so total asset value 100, which is funded by 90 billion liability and a 10 equity. So if you look at the maturity gap, what is the maturity gap? Original maturity gap. What is the maturity gap? maturity gap is MA minus ML. MA is WAI into summation MAI. ML is WLI LJ into MLJ. So what is the maturity gap of this one? Can someone tell? Huh? Can someone tell quickly? How long will it take for you to answer?
Is that 90?
I'm asking maturity gap. What is maturity gap? MA minus ML.
-2.
Minus 2. How did you get minus 2?
No, +2.
So very simple. I mean, only one asset, one liability, maturity gap is same as MA minus ML. You don't have to work out like this because here several assets. Here weighted average MA also 3 because only one asset. Weighted average ML also 1 because only one liability. So 3 minus 1, simply 2. So maturity gap is 2. It's very simple. One asset, one liability means it is the difference between MA and ML. So 3, MA 3, ML 1, 2. So very simple. You don't have to worry about working out like this because only one asset. Now take a scenario. Now current interest rate 10%. Assuming a parallel shift in both assets and liabilities from 10 to 11%. What is the impact on market values? Can someone calculate impact on market value of asset and market value of liabilities? Now remember, this is the theory we discussed. Pricing R generally is to fall in market value. Now as a result of this increase, market value of this asset and liability will change.
Sorry for interrupting, sir.
Yeah.
I think your battery is running out.
Huh?
Your laptops, I think the battery is running out, so it may got shut down.
Okay, let me see. I think can manage. Okay. Anyway, I'll see if I need. You can't see. Can't you see or what? I know it's very short, but can run for about 54 minutes. I will see to plug in if there is any problem because anyway we have 25 minutes more. No? You can't see. Is there anything causing problem for you all?
No, that's fine, sir.
Okay. I saw. Thank you. So I will ensure that no interruption to plug in. Okay. So if the interest rate rises to 11%, what would be the market value of assets and what would the market value of liability? Can someone tell? Can someone work out? We know the formula. The formula. So the current interest rates 10%. Can someone work out? Okay, you can work out using the formula, this formula. Now, in this case, I can easily give the answer for liabilities because it's a 1-year maturity. So your market value will decline to 89.19. It's only one cash flow. You see, because 1-year maturity, when it tries to 11% from 10%. So it's basically 90 plus 9 divided by, it's one cash flow, 90 plus at 10%. You get interest of 9 divided by new rate 11, 1.11. We apply this formula. So it's should definitely come to 89.1. Now, in the case of this, because 3 years, now you have to work out using the bond formula. What is the bond formula? So you have a 10% interest rate asset with a value of 100. So you will get every year 10 up to 3 years. But now interest rate increased to 11%. So you have to discount at 11%, right? So 10 first year discounted by 1.11, then 10 second year discounted by 1.11, and the final year 10 plus 100 discounted by 1.11. So your value is 97.5. When we work out example, we will look at how do we discount. But for the time being, whenever the interest rate rises to 11%, you end up with your asset value drop, your liability value drop. So your equity value drop. Now remember that the dangerous part is this. Now this is the interest rate risk. Now these changes ultimately impact the capital, right? Ultimately impact the capital. So you started a bank putting $10 million, 10 million rupees, but under this, now this is a very simple asset with 3-year maturity, liability 1-year maturity. When interest rate goes up by 1%, your equity drop by 1.63, negative 1.63. So what is the message this gives? If you have a higher maturity gap, now here the maturity gap is only 2 years. But if the maturity gap is higher, things would have been much worse. Okay, now let's move on to the third scenario. Now earlier we looked at 10 to 11. Now take a scenario 10 to 70. Now generally these sort of increases won't happen under the normal market conditions, right? But under a volatile market condition, suddenly interest rate may go. That has happened in many parts of the world in some difficult period. These rates, these increases or decreases can happen. Either way, go up or come down. So let's assume a scenario, interest rate goes up by 7% from 10 to 70. Now interest rate, now you can do a homework, calculate these numbers, whether you get the numbers. So your asset value come down to 84.53, your liability value come down to 84.61. Now what has happened? Now what has happened? What do you see? Can someone tell? Can someone tell? What has happened? Can you all see? At least. See the numbers. I think most of you are very experienced bankers. So what has happened? I'm asking not a difficult question. So now what has happened? It's in the slide.
There's a loss occurred. For that, it is funded by the equity.
Sorry?
There's a loss occurred. The income is the negative. In that case, the equity has funded for the loss to balance the sheet.
Okay. So basically, equity has become negative. Equity has become negative. So whatever the loss has resulted, a wiping off of equity from positive, we started with a positive 10 and negative 0.08 means there's a equity has, lost by 10.08. So basically, theoretically, what this sort of scenario means, theoretically. When a bank reaches this sort of a level, not only a bank, any institution, what you can say theoretically?
Bankruptcy position.
Bankrupt, insolvent. Technically, negative capital means insolvent, bankrupt. Tactically, you can continue as far as bank has liquidity to meet the liabilities, but theoretically, this is a technically insolvent bankruptcy. Whether a bank or any institution, let's say a company. Negative capital means more liabilities than the assets. So technically insolvent. So you have to declare bankruptcy. So that is the theoretical. But in practical sense, what does this tell us? This tells the danger of interest rate movements. So here we took a very simple example of a 2-year maturity gap. Maturity gap is 2 years, not a very long maturity gap. But what is the message we can get from here? Even if the maturity gap is small, 2 years not a big gap. Even if the maturity gap is small, if there is a significant increase in interest rate, now here since the maturity gap is positive, increasing interest rate would have resulted the problem. Okay. I'll put this way: significant change in interest rate. Here the interest rate rise. Because the rise only resulted in the loss. Okay, rise in the resulted in the loss has led the bank to bankrupt. So this is the danger of interest rate risk if not managed properly. Let me move on to, now this is what I say, 7% increase in R could induce insolvency with a maturity gap of 2. Maturity gap of 2 only. Let me let me highlight one more thing. Now, you know what is the situation of a smaller maturity gap where interest rate increased from 10 to 17%, end up. Now, just a 1 point now, to add to that, just a 1.5% interest rate change could wipe out a bank with an extremely maturity mismatch. Now here the gap is small, but interest rate rise is significant. But take the other way. Interest rate rise is small, just a 1.5%, but gap is 29 years. MA equal 30, ML equal 1. Okay. Even could wipe off the bank's capital. So it works both ways. Even a smaller gap, if your bank has a smaller gap, but the increase is significant, it could wipe off your capital as a result of interest rate changes, especially when you have this sort of a rising interest rate with a positive maturity gap. Even if the interest rate change is small, if you have a wider maturity gap, larger maturity gap, still the same thing can happen. It could wipe off your capital. So it works either way. Smaller gap, significant change of interest rate, or smaller interest rate change with a significant gap. So all this tells always better. Always better. Now, which one you have a control? Now, we are talking two things, maturity gap and the interest rate. Which one you can control? Or both?
Only maturity we can control. Interest rate, it's beyond our control.
You cannot control interest rate. It is market determined variable. You don't have a control. Market determined variable. So that is why we call interest rate risk. Interest rate, foreign exchange, equity prices, commodity prices. You don't have any control. Some market determined variable. You can only control your maturity. So as a bank, vigilant about maturity gaps. Vigilant about maturity gaps. Estimate the impact, possible impact that could arise on your maturity, impact arising on your equity as a result of maturity gap, as a result of interest rate changes and the maturity gap, and adjust the maturity gap accordingly. So that is the sole purpose of this model. So as a banker, from a risk perspective, you look at the changes that are taking place in the interest rate environment, that are possible interest rate scenarios, and look at your gaps and see the impacts, like a stress testing scenario. And when you see certain adverse, results, possible results, then probably you have to adjust your balance sheet appropriately. So the way to minimize, strategy to correct the mismatches through diversifying across assets and liabilities in terms of maturity. Okay. It should consider the degree of leverage on the balance sheet, proportion of assets funded by debt versus equity, duration or average life of asset or liability to cash flows rather than just maturities of assets and liabilities. Okay. So the strategy is look at the mismatches of maturities of assets and liabilities and try to diversify. But there are two problems here. We need to look at the degree of leverage, which is not captured here, and also duration, which is not captured, right? So the immunization technology is try to maintain your balance sheet. I mean, here I have given the 100% immunization, vaccination. Okay. If you can have a MGAP 0, you are in an ideal world, ideal bank. MA equal ML. Maturities of assets equal maturity liability, you are not subject to interest rate risk under this model. But even if you can maintain MA equal ML, that will not happen. But at least you are 99% safe. But problem is, practically it's not possible to make MA equal ML. Very difficult. As a banker, I don't think most of you are bankers. You can make maturity of asset equal maturity of liabilities all the time. But try to minimize. So what you try to do is at least ensure gap is at a comfortable level so that you can maintain, you can manage the risk to a somewhat comfortable level. Right? So even though this is somewhat a better model in the sense in terms of value, because this captures the value changes, this is, and also cash flows, this is a model somewhat appears to be comfortable than the gap model. But again, this does not fully protect the financial institution against the interest rate risk. So you don't get full coverage against the interest rate risk. The two reasons, one is the duration concept, other is the degree of leverage. So what is, I'll start with the leverage. So what do you mean by leverage? What do you mean by leverage? Anyone? Any thoughts? Leverage in the balance sheet? I mean, all of you know leverage, because when a customer comes to you, that is one of the most important thing you look at. Leverage.
Cushioning, like
Tell me the right, factors. Leverage. Now, let's say somebody comes and asks you 100 million rupees for his company. Don't you look at the leverage? Among many things, one thing is leverage, among many things. Anyone? There were several in the credit area. Definitely you should know this. Leverage?
Our loan capital against shares.
Sorry?
Our loan which we have granted against our shareholding.
Not really.
Debt to equity ratio?
Debt to equity ratio. Leverage. How you have funded your assets. Debt versus equity. So this is the something you always look when customer comes to and asks you a loan. Very basic thing. Among many things, you ask, okay, whether you are overly leveraged. If you have a higher debt to equity ratio, you are reluctant to give a loan, isn't it? Do you like to give a loan to your customer who is higher debt to equity ratio? Huh? You don't. Usually do like to give a loan to a customer, always have a lower debt to equity ratio. That means that is a measure of solvency. Higher debt to equity ratio means what? Companies has a higher insolvency risk. Lower debt to equity ratio means lower insolvency risk. So Debt to equity ratio measures the solvency. So here we are referring that to your bank, not to your customer. The bank's debt to equity. Bank's debt to equity. Why? Because bank's debt to equity is very high. Bankers are the ones which have a higher debt to equity ratios among many industries all over the world. Because 90% of your funds are debt. Now, debt refers even depositors' monies are debt, owned by the shareholders. It's not just what you borrow. When you mobilize a deposit, that is a debt, isn't it? Something you owe, but you call it a depositor's money, different name, but it is a debt. So the important factor is debt to leverage and the duration. Now, duration is what? Duration is not the maturity, actual time to maturity. Actual time to maturity. Now, if you take a treasury bond, let's take a very simple example of treasury bond, which pays semi-annual coupon, let's say 5-year treasury bond. You invest in a 5-year treasury bond, which pays semi-annual coupon at, let's say, 5% or whatever. So your maturity is 5 years, right? So 5-year treasury bond, your maturity is 5 years, because ultimately at the end of the 5 years, you will get your cash flow, the final face value. But the duration is less than 5 years. Duration is less than. Duration is if you take all those in-between cash flows also into account, you realize your investment less than a 5-year period. Average time to maturity. So the duration is a measure which defines average time to maturity, not the theoretical maturity. Now, when you say maturity here, this is 0.25, that is theoretical time. When you say this bond 3 years, that is theoretical maturity. But if this bond pays annual low, semi-annual coupon, then actual maturity is less than 3 years, right? So almost battery is running off, but we have come to the last part, so no worry. So if you combine those two into your model, to maturity model, we end up with a new model called duration gap model, right? So next week, we will discuss the duration gap model, which captures these two, which will give a better estimation about your interest rate risk, right? Okay, with that, I'll stop for the day. Are there any questions before we wind up? Anything you need to clarify?
So just from the risk departments and risk management committees, all these calculations are done. That's for the bank itself. Just wanted to understand whether from the supervision perspective, is there any monitoring? Is like banks has to submit any reports or kind of thing, because the semantic risk is there. So just wanted to understand whether regulator perspective,
I really don't know whether we are looking at these like duration and all those things. I really not sure, but basically the regulators will look at the policy part.
Right.
How, different, there are some risk management directions which covers basic framework for different risks like credit, market, liquidity. Remember, I discussed with you all in the first day. So policy part, but the policy framework you have in place within the bank, including these, different methodologies. So that, but of course, whether you have stick to a particular number, whether they have defined any number, I don't think so. But it's basically whether you have a set policy framework in terms of risk management.
Right. So it's the broad perspective the regulator is looking to.
Huh?
The broad perspective, whether the policies and procedures are in place from the
Yeah,
bank itself.
yeah, that's right.
Thank you.
But in terms of now certain countries which follows international models, like some regulators have come up with certain numbers they want to maintain. But here we basically follow very basic models. But internally, you can have your own numbers as a part of your risk management.
Thank you, sir.
Okay. Any other questions? Okay. If not, we will stop for the day. So we will meet with the rest of the lecture next week. Okay. Thank you.